Ladies and gentlemen, brace yourselves. As we teeter on the edge of yet another uncertain U.S. presidential election, central banks across the world are preparing to make their next moves. The Federal Reserve, alongside many other central banks of the wealthiest economies, is expected to embark on a new wave of interest rate cuts. This timing, shadowed by an unresolved U.S. election outcome, showcases once again how monetary policy is more of a high-wire act than a science. Let's take a moment and imagine this for what it truly is, a group of central bankers in a dimly lit room, feverishly clutching their interest rate tinkerings as the political landscape outside shifts like quicksand. It's almost poetic. In the midst of global economic slowdown, a never-ending inflationary chokehold, and trade wars just waiting to explode, central bankers still cling to rate policies like a toddler grasping a security blanket. First, a quick note about the election, because how can we not address the elephant, or donkey, in the room? Kamala Harris and Donald Trump are practically locked in a photo finish, the kind of electoral chaos that makes even the most seasoned pollster weak in the knees. Against this uncertain political backdrop, central banks are left to squint into their crystal balls. The question at hand, when in doubt, what do they rely on? Interest rates, of course. And why not? It's not as if decades of manipulating interest rates has ever triggered unintended consequences. Oh, wait. Rumors are swirling that following last September's eye-popping half-point reduction, we will now see incremental, quarter-point rate cuts. In translation, the Federal Reserve is thinking, we're already waist-deep in this mess. What's another small step into the unknown? Jerome Powell, the man with the unenviable job title of Federal Reserve Chair, will likely roll up to the podium after this decision with a stoic yet reassured demeanor. He'll tell us it's not about the politics, it's about the numbers, the economic indicators, knowing full well everyone's watching the political fallout from such moves closely. After all, whoever says the word economic recession first becomes the next media headline. Let's drill down into this. Despite the harrowing spectacle of inflation which we thought future AI might fix, the labor market is cooling at an alarming rate. The latest data shows the weakest hiring rate since 2020. What happened, you ask? Why didn't those interest hikes work magic? That's because, dear audience, the issue goes beyond sheer numbers. Every layoff, every weak hiring report denotes the same cry for help baked into our current economic dynamism. It's muddled. Now, let's step beyond America's borders and venture into the rest of the so-called developed economies. What do we see? Global central banks revisiting their cozy agendas on rate hikes and cuts. The Bank of England, Sweden's Riksbank, and Australia's Reserve Bank all have some edgy discussions ahead this week. From South America, where Brazil might actually rev up rate hikes, to sleepy Southeast Asia, where inflation is at odds with rate cuts, it's a global tangle of confusion. For instance, just look at the Bank of Canada. A 50-point basis cut was recently served, despite wrangling with mixed signals ranging from job numbers to weakening inflation. The crux of their governance? Swallow your fear, cut the rates. Here's a question that should start a conversation: if we slash rates when unemployment numbers are still ticking low, are rate cuts actually responding to economic needs, or have we simply become rate addicts? Meanwhile, over in Europe, there's more drama than a Shakespearean play. The Bank of England is having sleepless nights over higher borrowing costs alongside a rising fiscal deficit. But don't worry, friends, they still plan on cutting rates this week by a quarter point. Because apparently when you've hit the economic iceberg, the solution is to keep sailing straight into it. And if you thought the situation was all roses in China, think again. Their factory gate prices continue to slide, as does consumer inflation, which is teetering barely above the zero mark. Yet, China doesn't seem to be in a rush to shake their infamous zero-COVID strategy-like reluctance towards adjusting rates substantially downward. The United States might have the world's biggest economy, but economic woes in Brazil, Poland, Thailand, and Norway could be mistaken for repeats of an economic horror series. Brazil's central bank is expected to battle inflation pressures with rate hikes. And in Poland, while an easing of rates feels imminent, no one wants to make the first move too soon, lest it invites backlash. In essence, dear audience, we are witnessing a dynamic that can only be described as economically precarious. Imagine 20 central banks writhing in a collective stupor, like high schoolers cramming for an exam, unsure of which question will come next. Now, let's turn to labor markets, where we've been served some slight optimism, threaded heavily with complexity. Despite the weak hiring numbers, AI investments have buoyed productivity growth in some sectors. This new tech-boosted wave has central bankers hopeful that firms don't have to immediately cut wages or prices to cope with inflation. But we have to ask, can advances in technology really substitute for long-standing demands for fair wages and equitable distribution of capital gains? September's productivity numbers were somewhat elevated because firms invested in technologies to fix their labor shortage problems, but the reality remains, higher productivity through tech often benefits capital owners far more than laborers. This exacerbates inequality in income distribution and could stoke political unrest if not handled correctly. So is wage stagnation becoming the new normal? If corporations can afford to fluff their productivity books with AI and robotics advancements, will central bankers continuously ignore the wealth disparity that results from uneven wage distribution? Technology, economists keep telling us, is the great savior. But have you ever noticed, the faster productivity rises, the quicker we reach another economic, precarious point? Another significant pocket of concern involves Europe, where the Eurozone is grappling with sluggish growth, despite aggressive attempts to cool inflation. Take Germany, the industrial powerhouse of Europe, now staring down the barrel of sluggish export sectors and a lackluster third-quarter growth. France, Italy, and Spain. Ditto. Their stories read like chapters of a grim post-bailout retrospective. Meanwhile, the Bank of England continues its attempts at rate easing with yet another proposed quarter-point reduction. With public dissatisfaction rising over stagnant wages, inflation-weary consumers are getting fed up. The UK economy hit a low gear, but how will another fiscal stimulus coupled with rate cuts change things? Probably not enough before we hit another round of belt-tightening initiatives. That leaves some key questions on the table for ordinary consumers and auditors alike. Who foots the bill for the economic losses incurred from these globally synchronized policy experiments? How will regular consumers be shielded? What happens when inflation refuses to budge, even as central banks ease rates? Will geopolitical risks, namely trade frictions, exacerbate or alleviate macroeconomic tensions? Our central banks continue wielding interest rates like magic spells, pulling levers without fully comprehending the unseen consequences. Despite inflationary pressures, weak labor markets, and economic slowdown, the fixation on using rates as a cure-all for any and every economic malaise persists. It's like treating a fever with placebo pills. You get temporary relief, but you haven't cured the underlying infection. So now, we must ask, where do we go from here? Are central bankers truly out of ideas? Allow me to be the bearer of stark truth, they may not be as out of ideas as they are trapped by their historical failures to adequately address systemic flaws in modern economies. Excessive dependence on debt as a stimulant for growth. Technology-driven productivity gains that fail to deliver equitable benefits across social classes. And finally, a global trade system fragmented by protectionist policies, which central banks can do little to address while they remain hyper-focused on adjusting interest rates. In conclusion, as the U.S. election looms over us, we're left with a parade of rate cut announcements that feel less like strategic choices and more like panicked decisions made in the face of uncertainty. In this modern economic spectacle, improv dances around interest rates have substituted for thoughtful economic leadership. Constants like wage stagnation, inequality, and, of course, inflation, remain trapped in a feedback loop, endlessly delayed, but never truly solved. So, think twice the next time Jerome Powell struts into a press conference with another cut. It's not just a move to ease the economy, it's the latest chapter in the world's most bizarre game of economic hide-and-seek, where no one's entirely sure what they're hiding from anymore.